Hi everyone, this is Brian Neal with TradeToBeFree.com, and in the last market update that we did, we talked about how we had this bearish confirmation signal here at the beginning of the month. We went bearish on this candle here at the beginning of August, and market dropped about 5 or 6% since then, and then rebounded. And in the last update, we talked about how we wanted to see the market indices get above the 50-day moving average and above this prior swing high here. And we can see we came up and we almost tested it, couldn't quite get there. And then we had some more bad news today, and the market turned over, rolled over, and came back to test the bottom of this range that we're in right now here on both NASDAQ and S&P 500. And so with this move today, as we're coming down into the support level again, and with more volume coming in, as we can see here, it's a good chance we'll come through here, break this support, and come down and test this other support, next level of support right here around 7,300 or so, maybe, yeah, a little bit above there maybe. But it's looking like a very large, or pretty large, not real large, but a pretty large ABC down pattern. And if you take this move, this first move down, okay, take the length of that and project that from the high here, this swing high, that will bring you down to around the support level down here. And that's the way it's shaping up right now. There's going to be some announcements sometime later today as far as retaliation to the new China tariffs that were announced today. You know, that may drive the market lower. We'll see what that is. And we could see a break of this prior swing low here, and like I said, move down to this area here. That's how it's shaping up right now. If we look at the Russell 2000, the Russell 2000 small cap index is now back to where it was, below where it was at the end of January. Okay, so it continues to be well below the highs. It's getting close to a bear market. I think, you know, if we get another 2% lower here, it'll be in a bear market. And we can see that there's a formation here. This is a head and shoulders pattern, a bearish head and shoulders pattern. Okay, and the right shoulder is a little bit below the left shoulder here, although the pattern is kind of leaning to the downside. We had the same kind of pattern, although it's smaller. It was smaller in late, I think it was 2015 on the NASDAQ, and we put that in our alerts, and we have an example of that in our blog too. And we went bearish once it confirmed the bearish head and shoulders pattern. And then we saw the NASDAQ come down like 10%, 15% within a few weeks. So that's a possibility here. We could see the Russell 2000 to come back down. It could break through this line here, the neckline and the head and shoulders. You know, maybe it'll rebound a little bit on a possible Fed rate cut, which is likely. And then maybe after the rate cut, it'll come down and go lower, and you know, make a projection, full projection of this distance here between the neckline and the head, top of the head, and the pattern. The target on this pattern is taking this distance here and projecting it from the neckline at the point of the breakout to the downside, which is over here potentially. Okay, and that could lead us down and test this low here on the Russell 2000 small cap index. So that could happen. That's sort of developing right now, and it just depends on whether we close below here or not. That's the key. I mean, there's plenty of these head and shoulders patterns in the market all the time, and unless they trigger by closing below the neckline, I'm not real interested in it, because oftentimes they'll find support here and come back higher and rebound from there. So, but that's one thing that we're watching. If we look at the Treasury yield now on the 10-year, we can see that the Treasury yield has come down to nearly 1.5%. So we had this rebound here back to the 10-day moving average, and it turned over today, and now it's going back to test 1.5%. And again, that long-term support going back to 2016, I believe, was right around 1.35 or so percent, and we can take a look at a 6-year chart here and find out what that is. Yeah, 1.336%. So, you know, we might be coming down to test that area. We'll have to see. But this is a bearish candlestick pattern here. And, you know, we'll see where that travels in the days and the weeks ahead. One point of concern right now in the market is the 2-year and 10-year Treasury yield inversion, potentially. And we saw that intraday a couple times over the past 2 weeks, but it's still closing positive. Okay, so barely positive, but still positive, and that's the 2-year, 10-year Treasury curve. Now, if we look at the 3-month, 10-year curve, okay, the difference between the 3-month Treasury yield versus the 10-year yield. Okay, we can see that that difference is now down to 0.4%, below minus 0.4%. So it's inverted, has been inverted now since, I think back in March. Yeah, March here was the first time we saw the inversion, and then it went back positive for a little while, then it fell off, and now it continues to go lower. Okay, and the real reason that's a concern, as we pointed out back in March, is that it affects lending potentially. So, banks borrow short and they lend long. So in other words, they borrow at the right around the 3-month rate, and they lend at the 10-year rate potentially. But so far, we're still seeing loans being made, and the higher rates are still there to make lending profitable. And what really matters is that creditworthy borrowers are able to lend at a reasonable rate, and that's still the case. And it's also still the case that in most of the world we have a positive yield curve, a healthy yield curve, whereas in the U.S. here we have more of a flat yield curve, inverted on 3-month to 10-year spread, and then flat 2-year, 10-year spread. So in and of itself, that doesn't mean that the market's going to go down and go a lot lower. Okay, what really matters is that if lending is still going on, and right now it is. That's what we heard from the banks in the second quarter. So after the inversion in March here, we had April, May, and June. During a lot of that time, the yield curve was inverted. Okay, and then they came out in July and said that lending was going along just fine. So there's going to be concern, though, in the next quarter with banks. So once we get into earnings season and the banks start to report, they'll let us know, how that lending is going along in the most recent quarter. We'll also get more retail sales data. We'll also get more other information on the economy as we go along here. And right now, it's not too bad here in the U.S. And the U.S. is still holding up well, and the consumer is holding up well. We want to see that continue. Pretty soon, we're going to have an inversion in the 10-year, 2-year curve, potentially, in the days ahead or weeks ahead. But again, the 3-month, 10-year is, a lot of professionals look at that more than anything. That didn't seem to stop lending last quarter, and the bank profits came in really good. And the banks have a lot of capital reserves available. So here in the U.S., okay? We'll have to see how this plays out. What I look at is these signals in the overall market to see if institutions are unwinding positions or not. And we saw some early indication of that here in late July, early August. So far, it's held up pretty well since then. We had this first drop, pretty sharp, like 5 or 6% within a couple days. But then we've kind of gone sideways and held up really well. And then, now we're starting this test again of this prior support area. And it looks like we could break that and go down and test this area over here on the NASDAQ. So that's how it's shaping up. And we'll just see how it goes. I mean, we still could get support here at the, 7,700 area on the NASDAQ. We come back, we could test the 9 EMA or 20 EMA, and then turn over from there and come back down and take that second leg lower. Okay, so that's how it's shaping up right now. That could change at any point. We could get a trade deal. We could get a Fed that makes some really smart moves in the weeks ahead and that investors like. And we could see the yield curve on the 2-year, 10-year spread becoming more positive. That's sort of the headline yield curve, so to speak. So if that gets more positive in the weeks ahead, that could really settle the market down, and we could see a trend back to the upside. Okay, so what really matters to us is that right now we've seen the bearish market signal. We haven't seen a confirmation of a new uptrend. Okay, we wanted to get up here, all right, and hold up there to confirm a new trend, short-term trend to the upside. This is looking like an intermediate-term downtrend. Intermediate-term downtrend just means over the past few weeks to few months, that time frame. All right, the long-term uptrend is still to the upside and still in place. And what it looks like it's setting up here again is this intermediate-term downtrend, an ABC pattern to the downside, a test of this area, and then we'll just see how it goes from there. So we could easily see re-steepening of the yield curve, Fed that makes a lot of smart moves, a trade deal or sort of trade resolution one way or another, so the market participants know and businesses know what the tariffs are going to be. And I think once we see that and have that clarity, we could see the market rebound and start another rally from there. Until then, though, for our strategies, we want to go both long and short, pick the best short opportunities and the best long opportunities. And once the volatility gets above, say, 24, 25, pretty much all of our long strategies are off the table at that point. We don't want to see the volatility that high. As we get into the 20 to 25 range, a couple of our strategies, you'll notice in the courses that we have on the site, they're still in play. Okay, the best setups in those strategies could still do very well, like we saw with Roku, like we saw with EHTH, ENPH after earnings, and so forth this quarter. They made really big moves out of those strategies, using those strategies. So those are still in play. To buy a large consolidation pattern, breakout. If you get a breakout to new highs with no new news, nothing new to make the stock worth more that just came up. Those type of breakouts, those weak breakouts, tend to fail in this type of environment. Okay, if we start to see some traction in the market and the market start to move strongly higher, that will change. So this consolidation and this, if it turns into a correction, we'll set up some really good consolidation patterns in the weeks ahead. So this is a great opportunity to see which stocks in long-term uptrends have the best consolidation patterns. And if they have a great consolidation pattern, okay, where it's more narrow and it's holding up better, and it hits a good entry point, and the market at the same time starts to trend higher, all right, and confirms a new uptrend to the upside, then we'll have a lot of great opportunities in the daily alert and weekly alert that are likely to do really well from that point. So this is just a proving ground. These corrections or pullbacks in the market are proving grounds for the top stocks, and we'll see which ones hold up the best and which ones have the best consolidation patterns. Once we see signs that the market trend is going back higher, then the best ones will break out, and we'll have a lot of really good trades to look at from that point forward. So, okay. So until then, we're looking for the best long and short opportunities. This may be a nice wave lower for our shorts. We have flow right now is still in play. It nearly hit our final target today. I think it's up like 15% from our target entry point. We saw ENPH made a real nice move for the longs. We also had KL, which is a gold stock, in the alerts this past week. It was breaking out of a nice short-term downtrend within a great long-term uptrend and reached the entry point, and now it's up like 5%, I believe, already, just within the past 2-3 days since reaching the entry point. And ENPH made a nice first wave higher. We took the shares off around there, assuming that there'd be some news on Friday that could take the market lower and test this lower bound here, which we're doing right now, and could send us into a second leg lower into this area here, and then we'll just have to see how things shake out down there. But the best long trading setups and the best short trading setups are working really well. Just the ones that reach the entry point. Though, we want to see confirmation of the trend back toward the long-term trend. Okay, so if it's in a long-term uptrend and we're waiting for the consolidation to end and for the long-term uptrend to resume, we want to see the price hit that entry point that we have in the alerts. Okay, whether it's a long or a short. All right, so if you get in ahead of time, a lot of times it won't reach the entry point. Like with SPLK feature this week, it didn't reach the entry point that we had in the alerts, and it went lower after the open. Okay, so having a really good technical pattern and having the price reach the entry point consolidation pattern is really important. Okay, so a lot of people want to try to get in ahead of it, but that really lowers your win rate, and with this much volatility, it could break and move a lot lower. So we want to make sure the price reaches a good technical entry point. We want to have that catalyst that should make the price worth more, or the stock worth more. Okay, and again, just pick the best long and short trading setups and look at taking the position off at that first 4 to 10% move. So that first leg, lower or higher, with a tight stop loss. And really the best strategies right now are the ones, with a new catalyst, hitting an entry point, okay, and taking the stock off in that 4 to 15% range, profit range, with a tight stop. And you can do that with a high rate of success if you use our strategies on the site, and if you pay attention to the technical entry points and make sure the price gets there, okay? Otherwise, this type of environment will be difficult to trade, okay? So that's about it for now. Again, if you want a free trial of the site, you can go there, sign up with just a name and email address. There's no credit card required, and you'll get 3 weeks free, and you can see all of our past trading setups. You can see what the target entry point was. Okay, so the price has to reach the entry point to trigger a trade for us. And so you can see the ones that don't reach the entry point tend to oftentimes just fall off and continue in a short-term downtrend and take out the long-term uptrend support. Okay, so again, it's important for the stock to show signs of starting to trend back higher. And you can see that on display on the site with all of our featured trading setups over the past year and beyond. So, okay, that's about it for now. We'll talk to you again next week.